there's actually opportunities when the stock market corrects. Hey, listen, I know it's no fun when the stock market becomes volatile and you go through a market correction and you see your portfolio, man, it's just, starting to slide down. Now, when this happens, though, there are some opportunities to take advantage of. But before we get into that, if this is your first time here, hey, welcome. I appreciate your visit. My name is Keith Wilson. I'm a practicing financial advisor helping folks along their personal finance journey, right? Now, all right, first of all, what is a market correction? A market correction is when the market goes down as much as 10% from its previous high. And listen, they're pretty common and they occur pretty much every year. So when this happens, here are 4 things to consider doing in your portfolio. Number 1, this may be a good time to do what is called tax loss harvesting. Now, what you're doing here is you're selling a certain security or certain securities at a loss to help offset any securities that you sold for a gain. And this helps minimize or even eliminate capital gains tax. And even if you did not sell any security for a gain to offset, you can still deduct losses up to $3,000 per year. And if you have more than $3,000 in losses, those amounts, hey, they can be carried over for future years. Now, a few things to consider when performing tax loss harvesting, and that is this only applies to non-retirement accounts, not IRAs or 401ks. And you also need to be aware of the wash-sell rule. If you sell a stock or a mutual fund or an ETF at a loss and you turn right around and buy that same or substantially identical security within 30 days, that would trigger the wash sale rule and you would not be able to deduct the loss. So keep that in mind. Number 2, stock market corrections also offer an opportunity for Roth conversions. Now, you don't have to convert all of your IRA to a Roth IRA. You can convert as much or as little as you want. And you can also isolate securities in your IRA to convert. For example, let's say you have a fund in your IRA, man, that it's just tanked, but you think it will bounce back. Then by converting that to a Roth, if it does bounce back, you would be getting tax-free growth from it as long as certain rules are followed. Now, number 3, consider rebalancing your portfolio. Maybe over the years, certain positions you hold in the portfolio has really gone up. This may have caused your allocation to drift outside your original risk tolerance. For example, let's say that when you first set up the portfolio, you wanted 65% in stocks, 35% in bonds, but you haven't touched anything in years. It could very well be that you would have far more than 65% in stocks due to growth. So take a look at that and think about getting the portfolio back in balance. Number 4 is really important, and this is not a thing you should do, but really a thing you should not do, which is don't panic. Like I said before, stock market corrections are normal. They occur pretty much every year. And the last thing you want to do is let your emotions get the better of you. And just because there may be a temporary drop doesn't mean there would be no recovery. There have been many years when during the year the market was down in double digits but ended up positive in double digits. And according to Standard & Poor's since 1980, the average intra-year decline has been negative 14%, but annual returns were positive 32 out of 42 years. Still, I understand it may be tempting. You just want to sell out, wait it out, right? But that could be a very costly mistake because I think, according to JP Morgan, the 10 best days in the market over the past 20 years occurred after big declines. And if you miss out on the best days, then it's much harder to recover. So here's the thing, look at the opportunities when the market corrects, such as tax loss harvesting, Roth conversions, and rebalancing. But mainly, hey man, keep your wits about you and don't overreact.